Well, the company news side taken care of today. That's some of the data that's hit the market scene. We've had economic data also coming to the fore in the form of GDP data. Q1 GDP coming in at 4.6% quarter on quarter. And joining me to unpack the detail there is Azar Jammine, Chief Economist at Econometrix. Thanks so much, Azar, for joining us this afternoon. Sure. Well, looking at this number, I mean, expectation was for 4.3% expansion in the first quarter. It's come in at 4.6%. Your reaction to the number?
I think it's favourable. I think one must be gratified that economic growth has continued on its recovery path, which began in precisely the, we hit our low point in precisely the same quarter of last year. So, and we've had improvements in every single quarter since then. So one should be encouraged by that.
Let's delve into the detail here and look at exactly where growth is coming in from. I mean, what are the support factors?
Well, the primary support factors here were the primary industries, agriculture and mining. They comprised the lion's share of the improvement. To a lesser extent, secondary industries, manufacturing also supported the improvement. Interestingly, even though the services industries, including retail, did improve, the magnitude of improvement was somewhat less than in the other two sectors. So clearly what is driving this recovery is the recovery in the world economy and the increase in the demand for raw materials and agricultural products from South Africa, as well as the demand for processed materials.
There are risks to this growth story, though, and especially when you look at it from a global perspective. If we look at the EU, it's our biggest trading partner. They've got, if they have a weak economic period over there where, you know, we're clouded by uncertainty at this stage of the game, it is most certainly going to hit us, right?
Well, I'm not sure how much the EU economy itself will slow down. One should remember that the fall in the euro itself is going to provide a bit of a boost to Europe. Europe, I think, is just simply the symptom of a broader malaise that I have, and that is that in due course we are going to have to account for the massive increases in government debt levels in major industrialized countries. And I'm not sure at this stage, but if it does bring about another sharp downturn in global financial markets, then what is going to be left to try and get us out of that mess? Because everything's being tried. You've had this huge build-up of debt. What do you do next to try and extricate the world from such a downturn? And it is this more than anything that is concerning me, because of the high correlation between South Africa's economy and that of the rest of the world.
Certainly that correlation that had been questioned in the past now being given full support and, you know, being highlighted in the way that the economy has been affected throughout this crisis, right?
Absolutely. If you plot the growth rates in South Africa's economy against those of the major industrialized countries, it's a one-to-one correlation.
Let's take a look then at some of the local factors that we've got to keep in mind, because louder and louder threats of labor conflicts and the rise in labor conflicts are emerging on the local front. To what extent is this plaguing in the background?
Yes, look, it is a concern, but I would say that it's dwarfed by the concern regarding the global economy in terms of our short to medium term future. But it is a concern that you have labour unions pressing for double-digit, strong double-digit numbers in terms of wage increases at a time when inflation is down at 5% and at a time when nearly 1 million people have lost their jobs. I can't help thinking that the pressure for higher wages and the disruption by the labour unions is more a function of ideology, trying to send a message across about the growing inequalities in the distribution of income in South Africa between those who have skills, who are earning and doing very well, and those who are unskilled, who are either earning very low salaries.
And also an issue of timing, where we've got the World Cup 16 days away.
Of course, it's they're using their bargaining power right now.
Because one thing that has certainly been highlighted by Citi is the fact that we are seeing these labour conflicts arise more starkly in the public sector enterprises as opposed to private sector.
Of course, the difference between the public sector and the private sector is that in the public sector, the government doesn't lay off workers all that easily. Once it's taken them on, that keeps them, whereas in the private sector, businesses know that if they don't shed labour, they will go under.
Yeah.
So workers in the private sector are only too cognizant of this and therefore tend to temper their wage demands at a time like this. But I would like to remind people that Greece, for example, also suffered strikes just before the Olympic Games. So it's not an unusual thing.
And pretty much expected, it had been expected. Let's take a look at the unemployment picture, because this is a big factor to consider, where we saw unemployment hit 25%. Are we growing at the required rate, a sustainable rate, to actually up job creation moving forward?
South Africans need to recognize that we're not going to solve the unemployment situation simply through economic growth. The fundamental reason for high unemployment in South Africa is that the majority of people who are unemployed because they are unemployable. They lack the necessary skill and education to be marketable in the marketplace. In an economy that is increasingly shifting towards more technologically intensive processes, which require less labor and require whatever labor they do require needs to be more skilled.
Yeah.
So there's this disjuncture between the profile of our labor market and the direction in which the structure of the economy
So bearing
is
that disjuncture in mind, and the fact that we've got those who are employed fighting for above inflation wage increases, what's your view in terms of prospects for inflation? We've got CPI and PPI out this week. What are you expecting there?
Well, the short-term outlook for inflation is still very positive, because we've got negative inflation in agricultural prices, which will feed through towards lower food inflation. We've also got the prospect, the strength of the rand until recently, which will still temper goods inflation, and now most recently the fall back in oil prices, which could mean a reduction in fuel prices at the beginning of next year. So through to the third quarter, I think we're set fair for, if anything, for inflation to decline further. But beyond that, of course, higher labour costs and the fall in the rand most recently will start reigniting inflationary pressures.
Implications then for interest rates?
It means that in the short term, well, they could cut interest rates, but I don't believe they will, because they know that the danger is that inflation could start picking up a little later. Therefore, they will just sit on their hands, and I think they will do so for the rest of the year. And beyond that, well, who knows? It depends very much on whether we do have another financial crash which sees the rand falling dramatically, or whether we carry on with the kind of sideways movement in markets which will see the rand retaining current levels, which could see interest rates remaining at their current levels for a lot longer than what otherwise.
Lots of ifs and coulds and maybes and question marks still, but consensus seems to be that we are going to see the central bank probably sitting on its hands, as you say, and then possibly only think about starting raising rates come the beginning of next year.
That's right.